Preparing for a Boeing financial analyst interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through the 3 financial statements and how they connect. The income statement measures profitability, the balance sheet shows financial position, and the cash flow statement explains changes in cash. Net income flows into retained earnings and begins operating cash flow. Balance sheet changes in receivables, inventory, payables, and other working capital adjust that profit into cash. Capital expenditures reduce cash and increase property, plant, and equipment, while debt raises cash and increases liabilities. I always check that ending cash reconciles across the statements. While answering, focus on the income statement, balance sheet, and cash flow statement, then explain net income, working capital, capital expenditures, debt, and retained earnings links across the statements. Question 2. How would you analyze Boeing's financial performance for a quarter? I would begin with revenue, commercial deliveries, defense awards, and backlog quality. Next, I would compare gross and operating margins with the prior year, separating volume, mix, pricing, labor, supplier costs, and one-time program charges. I would then analyze operating cash flow, working capital, capital spending, and liquidity. Finally, I would reconcile actual results against guidance and consensus, investigate material variances, and assess whether the quarter changes my forward outlook. Make sure to cover revenue, deliveries, backlog, margins, operating cash flow, program charges, guidance changes, segment trends, unusual items, and comparisons with prior periods and expectations. Question 3. What is program accounting, and why is it relevant to Boeing? Program accounting groups a defined quantity of aircraft and estimates total revenues, costs, and profit across that accounting block. Boeing can recognize margin as aircraft are delivered based on the program's estimated average economics rather than treating every unit identically. The approach reflects learning curves and expected production efficiencies, but it depends heavily on forecasts. If costs, pricing, or deliveries change, Boeing may record an unfavorable adjustment, making estimate discipline essential. In your answer, talk about accounting quantities, estimated total program revenues and costs, margin recognition, production learning curves, estimate changes, and risks from delivery or cost assumptions. Question 4. How does ASC 606 revenue recognition apply to an aerospace manufacturer? Under ASC 606, I would identify the customer contract, separate performance obligations, determine the transaction price, allocate consideration, and recognize revenue when control transfers. For aerospace contracts, that may occur at aircraft delivery, over time for qualifying services, or as milestones are achieved. I would also monitor contract modifications, incentives, penalties, and variable consideration. Revenue recognition is not the same as cash collection, so contract assets, liabilities, and receivables deserve separate analysis. Be sure to mention contracts, performance obligations, transaction price, transfer of control, variable consideration, contract modifications, long-term programs, and the distinction between revenue and cash collection. Question 5. How would you evaluate Boeing's backlog? I would treat backlog as a starting point, not guaranteed revenue. I would examine firm orders, cancellations, customer deposits, aircraft mix, delivery timing, and exposure to financially weak customers. Then I would compare backlog with production capacity, supplier readiness, regulatory constraints, and available financing. A large backlog is valuable only if Boeing can deliver profitably and on schedule. I would also assess how much backlog converts into near-term revenue, margin, and cash. Focus on backlog value, order quality, cancellations, delivery timing, customer concentration, aircraft mix, pricing, financing risk, production capacity, and conversion into revenue and cash. Question 6. What is the difference between revenue growth and profitable growth at Boeing? Revenue growth comes from selling more aircraft, raising prices, or changing mix. Profitable growth requires those additional sales to generate attractive incremental margins and cash after labor, materials, rework, warranty, and support costs. For example, increasing deliveries while absorbing supplier premiums or production inefficiencies may grow revenue but reduce profit. I would therefore evaluate unit economics, contribution margin, cash conversion, and return on invested capital rather than relying on sales growth alone. Make sure to cover unit deliveries, pricing, product mix, cost per unit, learning curves, warranty exposure, working capital, cash conversion, and whether incremental sales create acceptable returns. Question 7. How would you build a financial forecast for Boeing? I would build the forecast from operational drivers rather than applying a simple revenue growth rate. For commercial aircraft, I would model deliveries, average selling prices, mix, production rates, and cost per unit. Defense and services would use contract awards, funded backlog, execution, and renewal assumptions. I would separately forecast working capital, capital expenditures, restructuring, debt, and interest. Finally, I would create base, upside, and downside cases tied to identifiable operational risks. In your answer, talk about delivery schedules, production rates, pricing, backlog conversion, segment assumptions, cost inflation, working capital, capital spending, financing, and explicit scenario drivers. Question 8. How do you perform a meaningful variance analysis? I start by quantifying the variance and ranking it by financial significance. Then I separate price, volume, mix, timing, productivity, labor, material, foreign exchange, and one-time effects. I speak with the responsible operating teams to distinguish symptoms from root causes, such as a delivery delay versus a permanent cost problem. The analysis should end with an updated forecast, an owner, and a corrective action, not merely a written explanation of historical results. While answering, focus on actual versus budget, price-volume mix, timing, productivity, labor, materials, foreign exchange, one-time items, root causes, and corrective actions. Question 9. Why is cash flow especially important when analyzing Boeing? Cash flow matters because aerospace programs require substantial investment before delivery and can experience long timing gaps between costs and collections. I would monitor customer advances, inventory growth, supplier payments, progress payments, delivery timing, capital expenditures, and debt service. Strong reported earnings do not guarantee liquidity if aircraft remain unfinished or working capital expands. For Boeing, operating cash flow also indicates whether operational recovery is translating into financial flexibility and lower funding needs. Be sure to mention delivery timing, customer advances, inventory, supplier payments, production disruptions, debt service, capital expenditures, and the difference between accounting earnings and liquidity. Question 10. How would you analyze Boeing's working capital? I would analyze each working capital component against revenue, production, deliveries, and historical trends. Inventory may rise because of build rates, unfinished aircraft, or quality rework. Receivables and contract assets may reflect billing timing. Customer advances and deferred revenue can support cash before delivery, while payables may temporarily improve liquidity. I would distinguish operational improvements from timing effects and quantify the cash impact of returning balances to normalized levels. Focus on receivables, contract assets, inventory, advances, payables, deferred revenue, days metrics, production disruptions, customer deposits, and sustainable versus temporary cash benefits. Question 11. How would you assess Boeing's liquidity and debt position? I would start with unrestricted cash, committed facilities, operating cash flow, and upcoming debt maturities. Then I would examine leverage, interest coverage, average borrowing costs, covenant flexibility, credit ratings, and access to capital markets. I would stress liquidity under lower deliveries, higher costs, and delayed cash recovery. The key question is not simply how much debt exists, but whether Boeing can fund operations, investment, and maturities without relying on unfavorable financing. In your answer, cover cash, undrawn facilities, maturities, interest expense, operating cash flow, debt ratios, refinancing risk, credit ratings, and stress case liquidity requirements. Question 12. How would you value Boeing using a discounted cash flow model? I would forecast unlevered free cash flow from operating drivers, deliveries, pricing, margins, taxes, depreciation, capital expenditures, and working capital. I would discount those cash flows using a WACC reflecting Boeing's business and financial risk, then calculate terminal value with a conservative perpetual growth rate or exit multiple. After discounting, I would subtract net debt and other claims to reach equity value. I would test the result through sensitivity tables and scenario analysis. Make sure to cover revenue drivers, margins, taxes, depreciation, capital expenditures, working capital, free cash flow, WACC, terminal value, net debt, and scenario analysis. Question 13. Which assumptions would matter most in a Boeing valuation? The most important assumptions would be delivery volume, production rate recovery, aircraft margin improvement, supplier performance, and the timing of cash flow normalization. I would also scrutinize working capital releases, capital expenditures, debt costs, WACC, and terminal growth. A small change in terminal value or recovery timing can materially affect valuation because cash flows are long dated. I would present ranges rather than false precision and explain which operational evidence supports each case. Be sure to mention delivery recovery, production rates, aircraft margins, backlog conversion, free cash flow timing, working capital normalization, discount rate, and terminal value sensitivity. Question 14. How would you evaluate a proposed Boeing capital investment? I would first clarify whether the investment expands capacity, improves quality, reduces costs, or maintains compliance. Then I would estimate incremental revenue, savings, labor, maintenance, tax effects, working capital, and residual value. I would calculate NPV and IRR using risk-adjusted assumptions, compare alternatives, and test utilization and schedule delays. I would also define post-investment metrics so management can compare actual benefits with the original business case and revise future capital allocation. Focus on strategic purpose, incremental cash flows, capacity utilization, production savings, risk-adjusted NPV, IRR, payback, maintenance spending, alternatives, and post-investment performance tracking. Question 15. Suppose aircraft deliveries fall 10% below plan. How would you estimate the financial impact? I would reduce deliveries by aircraft type and customer, then apply the relevant pricing, margin, and cash collection assumptions. I would separately model lost revenue, lower gross profit, delayed customer payments, inventory accumulation, and reduced fixed cost absorption. Some costs may be deferred, while others continue, so a 10% delivery decline does not automatically equal a 10% earnings decline. I would also assess whether the disruption changes future production rates, backlog timing, or liquidity requirements. In your answer, discuss lost revenue, margin mix, deferred cash collections, inventory, customer deposits, fixed cost absorption, working capital, delivery timing, and second-order production effects. Question 16. A major supplier disruption occurs. What would you do as a financial analyst? I would identify affected programs, parts, aircraft, customers, and delivery dates, then quantify the immediate revenue and cash exposure. Next, I would model alternative sourcing, expedited freight, labor inefficiencies, inventory buffers, penalties, and recovery timing. I would create base, delayed, and severe scenarios with clearly documented assumptions. I would communicate the financial range promptly, update the forecast as facts emerge, and avoid presenting uncertain estimates as confirmed results. Make sure to cover immediate exposure, affected programs, schedule impact, expediting costs, inventory, alternative sourcing, customer commitments, scenario modeling, communication, and control of assumptions. Question 17. How would you analyze the financial effect of a quality issue or production charge? I would separate the charge into direct rework, inspection, labor, materials, customer support, potential penalties, and schedule-related effects. I would determine whether costs are expensed immediately, capitalized, or incorporated into revised program estimates under the applicable accounting guidance. Beyond the initial charge, I would model delayed deliveries, cash timing, warranty exposure, and recurrence risk. I would also assess whether the issue changes forecast margins, backlog conversion, controls, or required disclosures. While answering, focus on direct costs, rework, inspections, warranty, schedule delays, customer compensation, accounting treatment, program estimates, disclosure, and recurrence risk. Question 18. How would interest rates or foreign exchange affect Boeing's financial outlook? Higher rates can increase interest expense, refinancing costs, customer financing pressure, and the discount rate used in valuation. Foreign exchange may affect translated results, supplier costs, and transactions denominated in currencies other than the reporting currency. I would distinguish translation effects from true cash exposure and review Boeing's hedging policy. I would quantify sensitivities rather than assume a uniform impact, because the effect depends on debt structure, geographic exposure, contract terms, and timing. Be sure to mention debt expense, customer financing, supplier costs, currency translation, transaction exposure, hedging, discount rates, and the difference between income statement and cash flow effects. Question 19. Which operating and financial KPIs would you include in a Boeing dashboard? My dashboard would combine operational and financial indicators. Operational measures would include deliveries, production rates, orders, backlog, inventory aging, defects, rework, supplier performance, and on-time delivery. Financial measures would include revenue, margin by segment or program, operating cash flow, working capital, capital spending, debt, liquidity, and forecast variance. I would highlight trends, thresholds, and owners, ensuring the dashboard explains performance drivers rather than becoming a long list of disconnected metrics. In your answer, mention deliveries, production rates, backlog, orders, inventory, defects, on-time performance, revenue, margins, cash flow, working capital, and forecast accuracy. Question 20. How would you ensure accuracy in a recurring management report? I would define each metric, identify authoritative data sources, and use a controlled template with documented formulas. Before distribution, I would reconcile totals to the general ledger or approved operational systems, compare results with prior periods, investigate unusual movements, and perform reasonableness checks. I would maintain version control, review evidence, and limit editing access. If an assumption is uncertain, I would label it clearly and escalate the issue rather than hide it. Focus on source data validation, reconciliations, version control, standardized definitions, review procedures, variance checks, documentation, access controls, and clear escalation of anomalies. Question 21. What Excel or financial modeling techniques would you use at Boeing? I would separate assumptions, calculations, outputs, and checks so another analyst can audit the model quickly. I use functions such as SUMIFs, XLOOKUP, index match, and logical scenario switches, while keeping hard codes limited to clearly labeled inputs. I would build linked schedules for deliveries, revenue, costs, working capital, and cash flow, then add balance checks and variance flags. For key uncertainties, I would use scenario tables rather than repeatedly editing formulas. Make sure to cover structured assumptions, linked schedules, XLOOKUP or index match, SUMIFs, error checks, scenario switches, sensitivity tables, auditability, and avoiding hard-coded outputs. Question 22. Describe a time you had to explain a complex financial issue to a non-finance partner. In that situation, I would begin with the business issue rather than accounting terminology. For example, I might explain that delayed deliveries reduce cash because completed work cannot yet be billed, while certain costs continue. I would use a simple bridge showing the operational driver, financial impact, and possible actions. I would confirm the partner's understanding, invite operational context, and finish with a recommendation, owner, and timing for the next update. In your answer, emphasize audience awareness, plain language, operational drivers, quantified impact, visual support, listening, confirmation of understanding, and a clear decision or next action. Question 23. What would you do if a manager asked you to make an unsupported forecast assumption? I would ask what evidence supports the assumption and explain the financial consequences if it is wrong. If evidence is limited, I would present a reasonable range, document the assumption, and show base and downside cases rather than silently changing the forecast. I would communicate respectfully and focus on decision quality, not confrontation. If the request involved misleading reporting or violated policy, I would escalate through the appropriate finance, compliance, or ethics channel. Be sure to mention professional judgment, evidence, transparency, documentation, alternative scenarios, escalation, accounting integrity, and respectful communication under deadline pressure. Question 24. Tell me about a time you found an error in financial analysis. I would describe a specific example using the situation, action, and result structure. I found an error by comparing a forecast trend with an independent operational metric, then traced it to a duplicated cost input. I quantified the effect, corrected the model, informed stakeholders before distribution, and documented the change. Finally, I added a reconciliation check and peer review step. The important message is that accuracy, transparency, and prevention matter more than hiding a mistake. While answering, focus on how you detected the issue, quantified its effect, corrected the model or report, communicated promptly, identified root cause, and implemented a preventive control. Question 25. Why do you want to be a financial analyst at Boeing? I am interested in Boeing because its financial decisions sit at the intersection of engineering, manufacturing, customers, regulation, and long-term capital allocation. That complexity would let me apply financial modeling while learning how operational performance drives program economics and cash flow. I am especially motivated by roles requiring disciplined forecasting, clear variance analysis, and strong partnership with non-finance teams. I would bring analytical rigor, curiosity, and accountability while helping management make better decisions. In your answer, connect Boeing's aerospace mission, complex programs, long planning horizons, operational transformation, analytical development, cross-functional work, and your specific skills and motivation. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.